Hello, Aditya Narain joined just now. Let's take our conversation forward. Aditya, good morning. Thank you for joining us. It's not looking bad at all. I mean, if I would have said inflation will be at 6% plus, crude would be at 70% plus, $70 plus, the monsoons are going to get delayed, guess the Nifty level, nobody would have guessed 15,800.
No, I think that's a very fair commentary. The traditional elements that have historically held back the market or shocked the market, whether it's inflation, whether it's oil, whether it's the fact that at the end of the day, GDP is fairly slack, you're on a little bit of a rebound, but the fact is you're operating off a lower level. So quite honestly, in a normal context, the markets would be seen to be holding very well. I think the reality is there is a little bit of a changed context. I think at two levels. One at a stock level in terms of the money that's floating around globally, and this is nothing new, but it's around. And the second thing is that you're expected to be on a reverting or a rebounding trajectory, both in terms of economic growth, but also earnings. So I think that's where the little bit of the balance is, that you shouldn't look at the negatives in isolation. There is another paradigm which is there on the other side, which is what is balancing out the market at these relatively high levels. But if one were to break, right, I think that's where the risk would come through. If the two were to continue to coalesce like this, which is you get the earnings, you get the economic growth, and at the same time, money stays easy, then, it might remain a lot more robust for a lot longer than what the traditional framework would tend to justify.
Your clients, caution or patience?
Hello.
Aditya, what are you telling your clients at this juncture? They should exercise caution or they should maintain patience?
Oh, sorry. I think in many senses, what we have for the market is a modest outlook for the next year. So at a market level, we are really looking at a 16,100 for the next 12 months. So fundamentally, at a broad market level, we'd say just be a little patient, right? But within it, I think we tend to believe there are some very distinct themes. There is the financial sector theme, which we think should provide you a certain rebound as economic growth starts translating into a certain amount of loan growth. There is the IT space and the tech space, which we believe is really in the midst of or in the early stages of what should be a long cycle. So that provides you a fair amount of support, right? And then there is the global theme where we do believe that the rest of the world is a little ahead of India in terms of rebounding, both from a policy perspective and from the economic data that you're getting. And so that's how you bias your portfolio. So bottom line, at the market level, we would be surprised if the market were to go up too much. But within that, to make absolute returns and make relative returns, there are distinctive themes to play.
Aditya, hi there, good morning. What about the overall corporate earnings season? How are you looking at the adjustments to the second wave of the pandemic, the potential third wave, and the overall economic backdrop back home?
So in many ways, the earnings season will be strong, right? We are looking at about a 20% growth on a 2-year CAGR basis. There's no point in looking at it relative to last year. But beyond that, we are actually looking at 20% growth. So I think at some level, the headlines there are going to be very, very significant, right? The other thing, of course, is that these are very dependent on a couple of sectors. So what you do have is that the commodities are driving you very aggressively, that the financial space will provide you a certain amount of support. And as I said, the exporters will provide you a certain amount of support, right? So at the end of the day, I think that is a headline that should provide you a certain amount of resilience and a little bit of comfort. It's not as pronounced as the headline suggests, because if you were to go below the profit level, EBITDA is going to grow at about 10-12% on a 2-year basis. But bottom line is, I think you're looking at an upward trajectory. You're looking at a very skewed trajectory. And I think that's important to keep in mind, both from a portfolio positioning perspective and a reflection of where the growth is. But I think you do have that tailwind with you, which tends to lend a certain amount of resilience as far as the market is concerned, right? That said, I think what we would tend to be a little watchful about, particularly on the domestic part, right, is that our sense is demand for the next 1 or 2 quarters could disappoint relative to what people are expecting. And the argument is simple. I think the market is extrapolating a rebound from the second wave, which is similar to the first wave. We think, the nature of the second wave, both in its breadth and its intensity, is going to create what we have termed the psychology of demand, which is, there will be a certain wariness, a certain lack of want, and a certain lack of willingness of people to come out and spend in the same manner that they did relative to the previous unwind, right? And to us, I think that is a near-term issue that, and I would say it's a 3 to 6 month issue, which the market is overlooking, which could be a source of disappointment when you look at high frequency data. And it could be a source of disappointment from a numbers perspective, particularly for domestic businesses and for discretionary businesses. So yes, I think the headline is going to be good. There is going to be a skew within it. The impact of the second wave just might be a little bit more and a little bit more extended than what's happened in the first wave.
Aditya, the last time we interacted, you said it's best to remain neutral on metals, owing to the fact that the pricing environment, they're in a territory where as of now, the pricing environment is likely to remain high. Does that stance continue to remain?
What tends to happen with stocks is there is a point in time when you are extrapolating higher earnings, right? Once the confidence in the higher earnings, right, this tends to start waffling a little bit or starts being debated a little bit more, that is the point in time when stock prices start stagnating, right? And I think that's where you find yourself. We're not necessarily making a call that there is going to be a slump as far as global commodity prices are concerned. But the best that you had to gain from a stock perspective, which is extrapolating an upward bias in stock price, in underlying commodity prices. Once that is done, stocks tend to be very sluggish in their behavior. And at some level, they carry the risk that prices start coming off quite a bit. You have to remember, you have to keep it in the context that a lot of these stocks have doubled or tripled literally over the course of the last 12 months. They are at reasonable valuations. The market is factoring in a high level of earnings. So I think it's best to be neutral at this point in time, unless someone has a very decisive call that commodity prices are going to start shooting up again, or if one has a decisive call on the other side, which is that they're going to slump off quite a bit.
Aditya, I wanted to also understand your take as to what the view is on big tech. You briefly touched upon it, and given that, new age internet companies are becoming the hot new thing, while valuations is an entirely different subject matter, how is it that you're reading into this entire boom and investors really capitalizing on this theme?
So we would be actually quite positively biased towards it, right? We've had a very strong IT call over the last 8 to 9 months. And that's really been premised on the fact that the front end of consumer tech is doing well. The traditional businesses are doing well, and you will start seeing a migration from them to becoming more tech. But coming to the consumer tech space, and I think we do have a big listing, and it should probably be the start of a longer cycle. I do believe that the space will be well valued, that there will be appetite for these businesses, and the reality is these businesses are doing very, very well, both in terms of the growth and in terms of improving unit economics, right? Which is very important. I think, traditional investing has always looked at it from a profit perspective. That notion has been disabused a little bit with what you've seen with such big tech in the US over the last 10 to 15 years. But I think what is most important is that if you can see in particular franchises improving unit economics, heading towards profitability, at least at the operating level, I think they will provide a lot of resilience in terms of how these stocks will be valued and how these stocks will do. So in that context, I would be actually quite comfortable with what you are seeing. I think what you're also seeing is some very good companies come to the market at this point in time. And I also think these are franchises, there are different ways of looking at franchises. But I think one way of looking at a franchise is that if that particular company were to disappear tomorrow or to be not there for access to the average man, would it be disruptive, right? And I think some of the companies that are coming to market now and which will come to market over the next couple of months, I think they have found a space for themselves in the Indian ecosystem, in the Indian consumer's mind, and there is a dependency factor for the Indian consumer on them, right? And I think that is an important element. That means they are here to stay. And as I said, if unit economics are improving, I think you will see fair valuation support for these businesses. Do they need to generate profitability at some point in time? Clearly they need to, but the fact that they're showing you that path means that they will do well and they're here to stay. And there's enough of a precedent in the US to not totally disabuse that notion.
Fair point. So are you saying that stocks like Zomato, Nykaa, whenever it goes public, Policy Bazaar, these should be at least 5-10% allocation of the portfolios?
So I do think that that's a space that you need to clearly look at very, very aggressively. I wouldn't want to get into individual company names, but I do think you need to be doing that. There has been a paucity of tech exposure in the Indian market, unlike both China and the US, right? And it's so going to be a little natural that the ones that come to the market out here should be bid up a little bit more in terms of the valuation framework that they get. And they should start becoming increasingly important parts of people's portfolios, whether 5 or 10 or more or less, I think that's always debatable. But I do think they should start forming a large part of people's portfolios. The businesses are here to stay. They are looking like, they are improving returns to shareholders. They're reducing their losses. Their franchises are increasing. So there's absolutely no reason why they shouldn't be part of your portfolios.
It's where I'm surprised that why markets are not recognizing it. I mean, everybody's talking about real estate making a comeback. Things are normalizing on the tourism front, hospitality front. Then why are HFCs underperforming? World is bullish on corporate banks, but nobody talks about HFCs because which is the first proxy to real estate or housing demand. HDFC has done nothing. Can Home is done nothing. PNB is into their own set of issues. If I look at other small players also, that is one space which has not participated at all.
So I think what you must remember is that a lot of these stocks actually tended to bounce early, right? And since then they have tended to stabilize or stagnate a certain amount. I think the reason for that is that growth for them, the delta with their businesses has not been that high. Even when things went down, their growth did not come up that dramatically. When things look up, their growth is not going to move up that exponentially. And so while the framework is positive, which is rates are low, and there is an increase in terms of volumes, at the end of the day, these are lower beta stocks or lower beta businesses, right? And so to that extent, when you're in recovery mode, you're not likely to get the same kind of response as you would get with sectors that have got beaten down more, either from a business front or from a valuation front, right? And I think that's where they lie at this point in time. So I think that's one element. Two, I think, housing is coming back fairly sharply, but I don't think it's at the level where, the fortunes of housing finance companies changed that dramatically. As I said, they never went down that much, even when housing was looking a little softer for an extended period of time. So in that context, I think that's where the story lies. I think one other thing that might be a little bit of an overhang, right? And this would tend to cover the banks and the retail lending space, is that there isn't enough of a call or an understanding at this point in time on how much has the middle market, which is the prime user of leverage, how much that has been impacted by these shutdowns and these waves and the pandemic as such, right? That combined with what I mentioned earlier, the psychology of demand, where people will just be a little psyched out of spending aggressively. I think these factors combine to make it a little bit of a question mark in terms of how much demand there is going to be for credit, how much capability there will be for credit to be taken up by people who were earlier in a position to do so. And that might just slow down the response or leave more questions open in terms of how quickly these businesses will respond. And I think that is why you're seeing a certain slackness with these guys. In part, as I said, for HFCs in specific, they never went down that much, so the business is not likely to go up that much, even though the environment is more conducive. And for the broader consumer credit space, where you don't know the damage because of the pandemic.
What is the best way to bet on this entire ESG theme? I mean, some are using the word madness, but let's say if I use that as a theme, where compulsion to be more environmental friendly or eco-friendly will be a necessity for an investor. If somebody says, look, I know that the world needs clean fuel, better energy sources, companies which are emitting carbon, carbon, they need to be penalized or they need to be avoided. That is a mega theme. You've done some work on it 3 or 4 years ago. What is the best way to bet on it now?
So I think what you really can, as you rightly mentioned, we did work 3-4 years ago, and we've been doing actually a lot of work on it subsequently. And there's also been a lot of market traction from this over the last couple of years. When we started out, if you remember, there was very little conversation around this. And it's something that's actually kind of entrenched itself clearly in the markets, but I think more importantly with businesses also, right? So I think there are two elements to this. One is the basic shift in businesses that move here, right? Which is whether it is clean energy, whether it is EVs, where you will see business lines move in this direction. And so there are going to be these macro shifts where either there'll be new businesses that capitalize on this, or there are old businesses that shift towards this. So I think that is one shift that has continued to kind of play through, right? I think the other thing is really, and that's the softer element of it, which is how socially friendly are these companies? How environmentally friendly are these companies, right? And from a governance perspective, how open are they? And I think that's where you're seeing much more work happen, which is you're still in the traditional space, but these guys are eschewing some of the negatives that they were carrying, and they're working towards the more positive side. And I would say, relative to 3 to 4 years ago, today it is much more of a belief system rather than a tick box system. There was a point in time where people were meeting these requirements, but it was meeting a regulatory requirement. Now I think it is a little bit more of a belief system. And I think this is where you're going to have interesting plays, because you will have individual companies that tend to do a little bit more towards this space. And you will also have, paradoxically, you will have a slight cost element and a slight transition element, which in the near term could actually weigh down in terms of earnings and things like that. So I think that's where there is also the mega shifts. I think a lot of people talk about the company specific shifts, and the change in orientation, I think, is where you need a little bit more scrutiny. So I think these are the two different trends that are taking place. And I think, they are here to stay, and you will tend to see much more of this. The world evolves, just like we moved more to tech by the nature of COVID. I think a less said thing about COVID is that this is something that's also got ingrained both in the markets and with businesses, and you will see this transition, right? But I think your opening point on, whether there's a certain madness around it, I think there is a certain madness around it in terms of conversation, in terms of maybe a certain amount of fund positioning, right? And in terms of the work that companies are doing on it. But I don't think there's madness around performance being that differential at this point in time, because I think we've always argued that this is the right way to do business. It should fundamentally show through in terms of stock performance and lesser regulatory risks. But it's not a on-off that you're doing ESG today, so your valuations are bumped up, and you're not doing it, so it gets bumped down. I think it's a process. It's a process that's underway. right? And the elements are the structural shifts that you're seeing and the company-specific changes that you're seeing. And I think you need to marry all of these. So I think it will be much, much more discussional, much more topical. There will be a lot of more back-end and strategic thinking with businesses. These are real shifts that will happen. But if you try and find discrete payoffs of these from a market perspective, I think that will be a little bit slower and a little bit more nuanced.